All right, so what the things that we need to talk about first, SPX, what were we thinking this morning? And it was pretty easy actually. Social media stuff was talking a lot about the S&P 500 this morning. And so it was like, okay, we need to do something on that. Specifically because CPI data was coming out this morning. And so when we looked at this, we can see there's a little bit of a implied volatility increase here on SPX. That's not that big of a deal. But when you look at term structure, that's a big deal right there. And so it looked like we were going to be able to potentially get a nice credit for our trouble if we did a credit spread on options expiring today. And so if we just go, and I'm just going to go look at stuff. I think we were looking right about here and here. And so if you could get, we were thinking a bigger credit than even that at 65 cents. We were thinking, you could probably get 70 or 80 cents. However, that would be completely conditional on the idea that the CPI data came out as expected, which ahead of the actual announcement this morning, there was no indication that anybody was expecting CPI to be as hot as it was. And as soon as we saw how hot it was, and we saw that we had a substantial drop, we just pulled the plug. And that's one of the beautiful things about trading credit spreads, especially on SPX, where it's a European style cash settled option. We could put the price that we were willing to take out there, and we could let it go and see if we got hit this morning. If the CPI was going to be pretty much what was expected, then we would have put a trade on and just attempted to see if we could get filled. If we did, great. If we didn't, great. And then the numbers came out. It was a shocking surprise that inflation is much more durable than and the Fed. If you look at the Fed chair, he was making the case. I thought I had, yeah, right there. Hot inflation, that's the headline right there this morning. Hot inflation reading reinforces Fed's cautious approach. So when we were listening to Jerome Powell speak at the last after the last Fed meeting, he said, we're not sure, we're not confident yet, but we'll just see what the data says. And so they're being cautious, and inflation is being stickier than the market expected. The Fed has been saying we're going to wait and see. We're going to let the data tell us when to start. The market's like, oh, they're not going to do it in March. They're going to do it in April. And they'll do it 7 times this year. They'll raise rates, or they'll lower rates 7 times this year. And the Fed's talking about, well, we might lower rates sometime this year. And so the market gets excited about and tries to anticipate what the Fed's going to do. But the Fed is just being cautious. They're doing what they say they're going to do. And then when this kind of CPI comes out, the market starts to panic. Oh, we're guessing wrong. But the Fed's probably, this is why we're not moving on rates yet. And so it's kind of interesting. But this headline could easily say hot inflation reading stops Brian and Don from doing a credit spread trade on SPX this morning. That's what happened. When doing these credit spreads, especially on a day when key data is coming out, it can be like stepping in front of a freight train that's moving towards you, and you don't know if the train has brakes. If they see you, you don't know, and you can get walloped if you jump in there. And in this case, we heard the siren on the train blow, and we can't tell that they're even going to stop, and we just decided not today. And you can see SP 500's down substantially, about 83 points. well below the area that we were considering doing a trade this morning. So we dodged a bullet. Another thing, so we've got a couple of things, other things that we need to talk about. Did anyone get into the Microsoft trade? It was a trade that we put on in November. It was a debit spread. And so the reason I'm asking is,
Yeah, I got into that.
Dave, you got into that? Are you out already or are you still in?
I'm still in.
Okay, that's exactly why we need to talk about it. um, so let's go look at Microsoft here real quick.
75.
Yeah, so the trade that we did, so you could have been bullish or bearish. But this trade expires on Friday. And the trade that we originally did was we bought the 375 and we sold the 400. And we did that for about 10 bucks. Okay, so I'm just going to go in here and say 20 and 10. So this is what it looks like right now because we don't have all the time in there. And the stock has substantially moved up into profitable territory. And when we're doing debit spreads, so most of the time I prefer to let my trade run all the way to the end because I want to let my profits run as far as they'll go. But when you do a debit spread, your profit ceiling, you've limited your profit potential in order to reduce your cost to get into trade and probably increase your probability. So when the stock price gets above the strike price of the option that you sold and time value starts to drop to where, because these expire on Friday. So what is the benefit of hanging on? So here's, and this is a 20-minute delayed. So this is just the my trade journal paper trading account kind of thing, where I get into all the trades that we recommend as trade ideas for the day. And you can see Microsoft's got in the money. They're expiring soon. The ITM's telling me that I need to be aware of that. If you did the put side of this trade, the put side is gone. If you did both, you're probably still in profitable. You're in profitable territory. But if you just did the call, if you did the call spread, or buy this at 375 and sell the 400, that's in the money. And a few minutes ago, I was looking at this and the limit price, because you can see here, the stock is now at 405. It's still above. The maximum net credit that we would get out of this if time value goes to zero is $25. And a few minutes ago, it was trading around 24.10. So we've been holding on to this since November. Do we want to keep holding for one more dollar when the stock has potential to drop? It's down 10 bucks today already. Or do we want to lock in a really nice profit on the trade and keep that going? So because if the stock closes above 400, we'll get 25. The option, we wouldn't have to do anything on Friday. The option that we bought would automatically exercise, and the option that we sold would automatically exercise. And we would get the difference between those two strike prices, which is 25. It would be a max profit and about a 150% gain. So let's do this. if you would like to, if you vote that we just take profits on the Microsoft trade, then we'll go ahead and do that now. And if you don't, if you want to stay in and go try to get a max profit, then don't raise your hand. We'll see how it votes. And I would like everybody to vote. And please vote the way that you would do it if you did have the trade. Even if you didn't do the trade, I would love to have you vote to decide and let me know what I should do with our class trade journal. So the trade is, we did a debit spread. We're very near a max profit, up 140%. Do we, if we exit now, and that's fine. If we don't exit now, that's fine too. And there we go. The balance is just tipped. We're going to exit. So I'm going to show you how we would exit. And this is what I would do. And I would just be, because this price that shows up right here is the difference between the bid and the ask. So I would start today by just, and especially since it was a few minutes ago at 24 and change. And we're just waiting for time value to fall off of that 400 strike, because the time value on the 375 strike is pretty close to zero already. So we're just waiting for that one to fall off. So I would just put in a limit order to get out at 24 and confirm and send. If by the end of the day today, it doesn't, we're not filled yet, we haven't gotten 24 out of it, I would probably just switch to a market order. And because typically when we want out, we just want out. And this is, I'm just trying to get, and there's a little bit more action at the end of the day. So there's a good chance we would be able to get filled on that option with at 24. So I'm gonna let that go. And if we don't get out at 24, if I don't get out here filled at 24, then I will put in a market order before the market closes, and we'll just use whatever those closing prices were in our trade journal. All right, another trade we need to talk about. I'm gonna lower some hands again so that we can vote again if we need to. So Palantir. So in this trade, we got in, when did we get in? We got in on the 2nd. Oh, that's not what I want to do. This is what I want to do.
2nd of February.
The 2nd of February. Yep, this is where we got in on this one. I'm going to go here, put in the 2nd. Well, that's the day that we did the analysis from. It expires in April, right? And yeah, so it expires in April. That's the trade we have. And you can see the stock has really moved up substantially. So this is the closing prices yesterday. And remember, I give myself permission to take profits when the price jumps outside of this probability cone. And we still have a lot of time. We don't have to take profits now. But whatever I do, when I do this kind of stuff, what I don't want to do is I don't want to get out completely, because I do want to let my profits run as far as they will. The issue is that the market's kind of, we just got some inflation data out today, and Palantir pulled back substantially in the morning. This morning, if you go look here, let's put you can see it pulled back a little bit this morning, substantially, and then started to come back up. So when I'm doing this, and I do have this trade myself, I have not decided yet if I want to pull half of my profits off and take some profits now. Um, I just don't. I haven't decided that yet. Because what I want to do before I do that is I'd love to have another opportunity. Ideally, I would love to have another opportunity, but this pullback right here this morning made me a little bit nervous. Um, and since then, and this is what I love about straddles. Straddles are my favorite strategy, and this is why. Um, well, and I'm going to pull up the homepage right here. When you start seeing news articles on the main pages of your news sites, here's Palantir right there. In other words, when everybody's talking about it, it's usually because you're making money. So let's go look at Bloomberg. I thought I saw some Palantir articles on Bloomberg. Oh, I saw some earlier. These guys update their stuff a lot quicker. But when everybody starts talking about the company that you're in the trade and it's a straddle trade, that's ideal. So here's an article. Here's another one. That's when you're rolling in it, right? And when we've gotten that's about a 2 standard deviation move, which is a nice profit. And if it does pull back to the middle, I don't want to give up all of that profit. So we're up substantially. What would I do? So if I did more than one contract and I'm in this trade, I would go, I don't sell the straddle. I just sell the profitable option. And in this case, if I did more than one, I would just sell half of my contracts instead of getting out of all of them, because the stock could pull back or it could keep going. It could go up 4 standard deviations. It could go up huge still. And I've had stocks do that before, and I got left out because I had pulled the plug earlier, and I was happy with a couple 100% gain.
Brian,
Yes.
now, based on your account size and stuff, let's just say if you're able to do more than one contract, let's just say, do you always do 2 contracts minimum for this purpose?
No, I don't.
Okay.
And it depends on the price of the options and all that kind of stuff. So this one was pretty small when we got into it. We ended up with net debit of about what, 350,
Yeah,
340. Yeah. And so this one was pretty cheap to get into. So it depends on the cost. If I was trying to do a straddle on Tesla or
Yeah.
or Nvidia, it would have cost me 40 grand. So
The other side of that trade, I did what you said on the probability cone, and I got out.
profits.
I took the profit. Oh, I only had one contract.
Okay, so here's what I would do if I only have one contract. I would still want to stay in. Here's the way that I would do it. But I would sell the contract so in this case I would sell the call, and I would roll up. So I would buy the at the money strike price. So where the stock is now at 24. It's the delta equivalent of selling half. So what you can do by looking at this, let me see if I can get delta on here. So you'll see that the delta on this strike is 96. So it's almost making money dollar for dollar. So if I buy an at the money, the delta is going to be closer to 50%. So I'm doing the delta equivalent. If I sell this one and buy this one, I'm doing the delta equivalent of selling half of my position. And I take a lot of profits off the table. So I would sell this one for about 845. I'd buy this one for 242. That takes off about $600 per contract. And if I only did one contract, it's a profit of $600 when I paid 300 to begin with. So I'm locking in a 100% gain.
You let the other side just expire worthless.
I hang on to it, and because the stock can reverse and go down to where it will make money for me as well. If I doesn't do that, if the stock continues to move up, then I would close this option later and let that one expire worthless.
Yeah.
Yep. Because if you look over here, it's only worth 11 cents right now. So I don't want to sell it cheap. We're in the business of selling high and buying low, right? And so if I closed out the 16 put now, I'd be selling low, and I bought it high. And so I would just leave it, because if it turns around and the stock does go down and retraces all of that distance that we've made already, then we go. So what I would like to do is have you guys vote. Do we want to take some profits off of this one now? Or do we want to let it just keep running? Because, the best scenario is that it keeps running and we make even more money. We've got a delta that we're making 96 cents for the next dollar. We're almost making money dollar for dollar on this stock if it continues to rise higher.
You rolled up on that April contract?
So I would keep that April contract, and I would just roll the strike price from 16 up to 24.
Okay.
Yep. If I just did one contract. So let's do the raising hands thing again. Do we go ahead and take profits off the table now? Or do we hang on and wait?
I can't raise my hands. I would actually take the profits now.
Okay, Greg, thanks.
Yeah, and I've already taken the profit.
And Al did already. JP, okay, it's all tipped. So here's how I would do that. And I'm gonna do it because I only did one contract in the paper trading journal here. So I would just, if I only did one contract, this is how I do it. If I did more than one contract, I would just sell half of the calls. But since in this case, I only have one, so I'd keep the same April expiration. I would sell the 16 that we owned, and I would buy the 24, and that lets me take a credit of $12 or $612 off the table. And so I hit confirm send, and that filled instantly.
And you're just rolling up on that one.
I just rolled that one
Oh.
strike. Yep, I just rolled the one strike up from 16 to 24, and now I've got a really wide strangle. So this is what the profit loss graph looks like here. And I think I just got filled on the other trade at 24 because it just beeped at me. So the 24 is the one we own now, and the 16 put is the one we owe. So, and you can see it's got some profit potential still down here on this side, but it's a really wide strangle. And the thing about this is it's the net debit is not $3.02. It's actually guaranteed profit because we did this trade already. So all these options that we have now are free in our hands, and we've locked in a gain that's depending on the price that you paid originally. If you paid about $3.50, then you got close to not quite 100%, about an 85, 89% profit out of the trade that's locked in. In the worst case scenario, you make, something pretty good out of this. And you still have options that could run further, or it could turn around and come back down, crashing down, and make you money that way. So that is that.